Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day, and before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personal service and often the lowest price, period, with no minimum purchase for silver, gold, platinum, or osmium. ARC SGO is available to discuss precious metals by email, phone, or in person at their retail location in Jackson, Wyoming, and they are committed to providing the best prices out there and making sure you get the best value and lowest premiums on their wide selection of products. Go to arcsgo.com and contact the owner, Ian Everard, at 307-264-9441 or Ian at arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is an expert in technical analysis, a veteran trader, and the founder and chief market strategist at The Technical Traders. We're going to dive into his investment and trading strategy and get his view on the broad market, commodities, and more. It's Chris Vermeulen. Welcome to the show.
Hey, thanks for having me, Jesse. Pleasure to be here.
Yeah, thanks for coming on the show. I want to get started with your current view on the broad market and let us know if you're bullish or bearish. A lot of people pounding the table right now that we're massively overvalued. I had Michael Pinto on the show recently, and he was very loudly vocalizing that the market is extremely overvalued. We're in a bubble and due for a correction. I'm wondering what your thoughts are.
Yeah, I feel the same way. I think the markets are due for a fairly steep correction. There's all kinds of different things pointing to this, so I'm pretty bearish. I was hoping and expecting the SP 500 to hit an all-time high this year, and then once it hits that, which we're at now, I want to see how the market, how investors and active traders are going to react. And what I'm looking for in a nutshell is the market's hit new all-time highs. Everybody who missed the big rally last year, who was too scared to get in, finally realizes, hey, all the headline news is, index is hitting new all-time highs. So they're going to have that FOMO. They're going to pile in. We've started to see this. We're seeing the ARC ETFs. We're seeing semiconductors, which is AI driven, but a lot of very volatile, fast moving, even small cap stocks starting to move higher. And that is the general public, I think, starting to pile back in, thinking we're starting another major bull market, which we are in a bull market right now. But I do think it is close to a top. And that's what I wanted to see is, are we sucking in the rest of the people who aren't in? Are they piling into aggressive stocks? And are we going to see distribution selling, which about a couple of weeks ago, we had a big down day in the stock market. Everything got slaughtered and was down sharply. Even gold miners were down 6-7% on the day. And there was no safety. It was just money unloading shares, I think, knowing they're getting a premium, big institutions, and unloading into the open market. And that's like the first time we've seen that. But I'm expecting we're going to start seeing that more and more. And that is really, the big institutions. I think a lot of them see the music coming to an end. I think a lot of them feel like we're very frothy, and they want to start trimming off positions. And there's different indexes are showing us different stories, and the Russell 2000 is definitely one that's giving us a big red flag that we're super close to a big collapse here in 2024.
Well, talk to us about what you're seeing then in the Russell 2000 that leads you to that conclusion.
Sure. Yeah. If we take a look at the Russell 2000 chart, if we take a look at the monthly chart of the Russell 2000, where we're at right now, and this is what the big tech companies are masking what's going on in the majority of stocks. So people who are holding a lot of individual stocks, a lot of growth and technology stocks are actually suffering pretty sharply. The indexes are doing all the heavy lifting. And what the Russell 2000 is showing us here is we've got this great big consolidation. And so we've had a big break to the downside. This was in 2021, 2022. And this is a bearish pattern. And typically this is the halfway point, meaning this market could fall very sharply to the downside at any point. And what's interesting is we've had the small caps do very well. They've had a very strong move. They're actually showing that we might see one more little push higher here before I think we run out of steam. And this is because we're seeing the general public moving into the aggressive small cap stocks. Now, we started to see the stock market top out here in 2018 as well. It put in one of these consolidation patterns. People then finally started to pile back into the small caps, kind of sucked in the last people who hadn't got into it yet, and then the market sold off. This was a COVID crash. But we've seen this happen over and over again. This is the 2007, 2008 major market top. We saw a breakdown in the Russell. Now everything is dwarfed because of the recent price action. But when we look at it, this is the same type of price action. We saw the Russell 2000 trade sideways. It had one more push up here. Everybody piled in, and then huge distribution selling came in. Institutions unloaded their aggressive small cap stocks because there was liquidity. People wanted to move into the markets. They literally unloaded their shares into the hands of the investors. And then we saw a huge sell-off in the equities market. So this pattern with small caps happens over and over again. They're kind of a leading indicator. They're nowhere near all-time highs like the index, like the SP 500 and the NASDAQ, which are tech driven. So this is a major problem. And a lot of this actually comes back, Jesse, to Stan Weinstein's theory of the 4 stages of the market. Let me just to recap on the 4 stages really quickly. Stage 1 is a basing formation. You really you want to avoid the markets during this time. It's dead money. You're best to go find a different asset class to go into. Who knows? It could be a currency, it could be bonds, it could be stocks, whatever that is. Stage 2 is a bull market phase. It's green because it's got a strong trend. This is what everybody lives for and wants. And right now we are in a stage 3 topping phase. This is what the majority of stocks are doing. They're in this sideways channel, really, and the broad indexes are holding up and hitting new highs, really sucking a lot of people in. But what they don't realize is eventually we're going to start to see this sell off, and we're going to go into a huge stage 4 decline, which is similar to the 2008 bear market. The tech bubble was a stage 4 decline as well. These are very devastating, but I color them green because they're huge opportunities to not only profit from falling pricing, but then we have even more capital after the whole cycle takes place for us to get involved in the best sectors, the best commodities during the next major run up, very similar to precious metal space after the 2008 crash. So if you understand the stages and what strategies, every stage requires a different strategy. You need to focus on different assets at different times. If you understand this core principle, it allows you to really navigate these markets with a very clear mind, have proper expectations. Stage 3 is about preserving capital, not really making a ton. Stage 1 is difficult. It's really preserving capital as well, preparing for the next major move to the upside. And then stage 2 and stage 4 are very strong trends. And that's where a lot of money can be made. So that's kind of where I see us in the nutshell, overall grand picture here is we are kind of in this topping condition. Really the highest amount of risk is for anyone getting into the market right now. I think there's a full cycle to the downside, and eventually it'll reset commodities and stocks and real estate and all kinds of different things.
So when it comes to the commodity space, are you sitting on the sidelines for now in anticipation of a stage 4 decline? Is there anywhere you're currently seeing opportunity? You know, uranium's obviously been quite a success over the last year, correcting somewhat at this moment. The long-term fundamentals look rather bullish. Gold and silver, is there anywhere where you could see deploying capital in the commodity space now? And in the case of the stage 4 decline, where would you be looking specifically for value?
Yeah, so good question. So we recently played the uranium play. We got in, we caught a move up. We've moved out of that. Precious metals, I'm a big fan of holding physical metals long term, not as a huge trade to try and make a grand slam, but as a insurance plan. It's just an asset that I like to keep a percentage of my portfolio or my wealth kind of in physical metals in case currencies collapse or financial systems blow up, whatever. But really, I don't see a whole lot of opportunity in the commodity space right now. I think they're fairly valued, but I do think if we go through a stage 4 decline, and this happens all the time, is pretty much everything gets sucked down with it. So we will see the precious metal space. We'll probably see uranium. All of those get beat up really badly during that sell-off, and they'll probably be the first ones to bottom and rally and recover. And when that next major cycle starts, that's when I'm actually going to be really excited for the value play to get into miners, potentially uranium stocks, because those are the ones that will be probably undervalued from the panic selling and the forced liquidation, margin calls that take place. And those are the plays that can rally hundreds, thousands of percent. And these super cycles really don't happen that often, every 10, 15 years, and they take years to unfold. So they've been unfolding and it's brewing. And I think we're in like that last quarter of the game where we just need this stage 4 or stage 3 to end. We need to go into this distribution phase. And, unfortunately, it's going to be difficult for a lot of people. They're going to lose half their wealth probably. All kinds of financial stress causes all kinds of other issues. So it'll become a very, really crappy environment for most people, unfortunately, but it does give us that reset. And that's the final straw we need before the next major super cycle, not only in precious metals and in commodities, but I also think we're going to see stocks, have a huge rally after all this is done. But this is going to take probably 6, 8, 12 months to unfold still.
And any thoughts on the oil and gas space at present and the potential opportunity it might present? Obviously, a very complicated market with such a huge confluence of factors playing a role in the price action. How are you looking at the oil and gas space right now? And do you see the opportunity for upside in the case of this stage 4 decline?
Yeah. So generally, like this is the monthly chart of natural gas, and just looking at cycle analysis, just cyclical kind of highs and lows, how the market goes through these waves. We just had one of these big blow off moves. Every 3-4 years, we have these major cycles. So natural gas is getting pretty darn cheap. I think it could continue to stay down here for a little while. I think it's going to start another major cycle to the upside. What I have found is when there's massive panic selling in the stock market and there's a lot of fear in the market, natural gas for some reason likes to go up in many cases. So I think natural gas, I think most of the downside is out of natural gas. Problem is, if you're an equities trader, there isn't a good way to play it. ETFs around this are just deadly. You don't want to hold them. You really need it to be in an uptrend when it's already moving and make your money and get out. So it's tough to play that. I think crude oil has got quite a bit of downside potential still. I think we're going to eventually kind of kick into a recession. You've seen overseas, a lot of other countries have already said, hey, we're in a recession. The US has, got different ways of measuring those things and inflation and all that stuff and kind of mask it. I believe we're already starting a recession, but I think crude oil will be down in the $40 range, potentially 6-8 months from now, very easily. And a lot of people are like, well, that's way too cheap. It can't get down there. But if we just draw a line across this chart at $40, you can see the $40 mark is really a very significant pivot zone. It has hit this $40 level so many times over the past, 20 years. It's not cheap for oil. It goes to this price fairly frequently. And we've just had a huge blow off phase to the top. This is typically what we've seen is we see crude oil skyrocket, usually just before the stock market goes into a massive recession. And then it has a little consolidation. And the monthly chart on here actually kind of hides it, but there was a consolidation right through this area. And we've actually had a similar move. We have this consolidation right through this area here, which is pointing to a big breakdown in oil. So I'm pretty bearish on the space. I think, again, almost everything is going to go down. You need to kind of get out of the commodity space. You need to get out of the equities markets into different assets that'll go up during chaos, which bonds could become a very good play. And the US dollar index, the ETF for that could be a very good play. If we look at the US dollar index, it had a huge run in 2022. It was like one of the only assets that really moved up. It is on the super cycle to the upside. It has a very strong bull flag pattern pointing to, $1.20, $1.21, which means commodities are going to get hit because of the rising dollar. Typically, we see the dollar rally when the stock market crashes, when there's chaos in a bear market. We saw that back in 2000. The dollar had these huge rallies to the upside just before we went into the stage 4 decline. We saw the dollar have massive rally as we went into 2008 financial crash. And I think we're going to go into another crash and send this back up to a major, major high. And that is going to put a lot of pressure on commodities. But all of this stuff, even though it may sound negative, is great. If you understand what's unfolding, what's moving and where and when, it allows you to take advantage of these. So I'm very bullish on the dollar. I'm pretty bearish on everything else. With that said, as a shorter term trader and investor, we are long the markets. We're riding these up. We're not holding any commodities at this point, other than I hold physical metals just long term. And eventually, if when we have the financial reset, I'll be looking to buy into the precious metal space, probably with miners as the leverage play to really, amplify, supercharge the returns on that portion of capital that I put to the commodity space.
And when it comes to physical precious metals, do you view silver in the same light as gold? Do you view it more as an industrial commodity? And if you hold both, at what ratio do you hold each of them in terms of the metal itself?
Yeah, I probably hold about 60% silver and then 40% gold. I look at silver, I don't really look at it as industrial. I mean, I don't even, I don't really even look at it as a precious metal. I just look at it as the leverage play around gold. It really just is kind of that rocket. It's more of like the small cap stocks to me of like the precious metal space. It's volatile, it moves fast, it underperforms for a while, and then will take off like a rocket and play catch up and go beyond gold. So it's really just the volatile play. It's the aggressive play to take advantage of a super cycle, a big move in the market. So you need everything to be aligned. Once all the markets, when gold is moving up, silver is moving up, miners are moving up, they're all in confirmed uptrends. The dollar is starting a downtrend. That will be like the perfect storm. We've probably gone through a bear market already, so things have been cleansed. That'll be the perfect storm where silver will definitely be the preferred play. Silver miners will also be, the high leverage play on that. So I just look at it as the small cap aggressive play that you don't want to touch unless it's in the perfect market environment. And we're not there yet.
Is the era of dollar cost averaging into an index fund and calling it a day over? Obviously, low interest rates provided a huge tailwind to that strategy. Do investors need to alter how they think about the market now?
I think they do. Like, I believe we're kind of up in nosebleed section. I think anybody who gets in here is buying at maximum peak risk. There's a lot more downside potential than there is upside for the next few years. Dollar cost averaging, I mean, it works if you're really young, you got 20, 30, 40 years. But the problem with dollar cost averaging is like really average poor returns. You're buying at a premium right now, and then you're buying some at a discount later. And the problem is a lot of people don't want to actually buy when it's at a discount in a bear market. People are the opposite. They want in now, but they don't want to buy after markets have corrected because their portfolio lost so much. They're scared to get in it. So the dollar cost averaging is tough to even follow, believe it or not. But you get these terrible average returns because you're holding stocks as they're going down. And I'm not a fan of that strategy. When you can completely sidestep it, if you follow price. As investors, we want things to go up. So if something's going down and we can identify that, why would we want to hold on to something that's going down? We'd rather move out of that, lock in our gains, and move to a different type of asset.
Well, that leads us to your investment strategy, asset revesting. The Technical Traders made a post on X recently where you wrote asset revesting is the first step toward freedom. So what is asset revesting, and how can your average retail investor wrap their head around it and implement that sort of strategy?
Right. So from a really high level to really kind of break it down, I look at the stock market as the ocean. So when the tide's going up, it lifts all boats. When the tide's going down, they all go down. The stock market is the same. It doesn't matter if you own 150 stocks in different sectors. When the stock market is in a bull market, they're naturally all going up. When you're in a bear market or a stage 4 decline, they're all going down. Now, the big difference here is people think, they're diversified when they own 50 stocks, 10 stocks, 150 stocks, whatever it is. To me, they're not diversified at all. If you own stock, if just because your money's spread around the stock market doesn't mean you're diversified. All you do is you own a whole bunch of the same thing. The equities market is one asset. So you have to look at it as one thing. It's either in favor, you're long, you want to be in it, or it's not moving higher and you're out of it, like 100% out of it. Diversifying doesn't do anything in terms of it gives you really crappy average returns because some of them will do well, other ones are going to do really poorly. And what asset revesting is we look at ourselves as like surfers floating out past the break. And what are we waiting for? We're waiting for a clean set of waves to come in. Every few weeks or every couple of months, there's a brand new set of waves that roll in through the stock market. and we pick the asset class that fits our style, that fits our risk tolerances. We move into that asset because we can see momentum and strength behind it. It's a clean movement, and we ride that for everything we can. And the nice thing about riding something with a strong trend is you can also tell when it's starting to weaken. You can tell when it starts to reverse direction using technical analysis, which is just following price. And we can carve out of that wave and float out there in cash or in a different ETF that's moving up, waiting for the next really clean wave to come through. And so there's like 5 to 12 of these trades every year. And we just kind of hop in the markets and we ride these waves higher. And the nice thing about it is when we do go into a stage 4 decline, which is very, we had the 2000 tech bubble burst. That was a bear market for several years. We can benefit from falling prices by moving into inverse ETFs or moving into the dollar index. Same with the 2008. When people are losing their shirts, we can continue to grow our account because we move out of whatever's going down and we move into something that is going up. So we're reinvesting our capital into something better versus the buy and hold. Doing nothing is dangerous. It's an extreme move, in my opinion. And being a really active trader is very dangerous because most active traders lose money. There's all kinds of studies that show if you actively trade for 300 days or more, you lose money. And so asset revesting is like kind of in between. We do just enough moves that we catch these multi-month waves, and then we step aside. And as the market corrects or pauses for a month or so, we move into something else that is moving up. That is very low volatility. It could be the dollar index or a treasury note ETF where we just collect daily interest. So it's a very low risk kind of portfolio design that really allows us to amplify returns.
So do you have an algorithm in place to kind of give you a heads up as to which asset categories at the moment might be this perfect clean wave and which ones it might be time to get out of?
Yeah, just to some regard, we do. We've got all kinds of different analysis that we scrape out of the market. So, for example, if we take a look at the charts here, this is the daily chart of the SP 500, and this is pretty simple. The strategy breaks it down and color codes it when we want to get in, when there's a new movement, a new wave, and it'll be red when it's to the downside. And we just follow these signals. So the trading strategy analyzes the markets, and we break the markets down in a lot of different ways. So we don't only use price action, but we use market sentiment, we use cycles, we use money flows. And you can get a little view of that on this right-hand chart. This is the SP 500, same window. And what we like to see during an uptrend are these red bars. When we get red bars, these are periods where investors, short-term investors, are panicking. They're selling all their positions. They're buying downside. They're betting on the markets. They're buying put options or inverse ETFs. And typically when our strategy sees these things, everybody's betting for the markets to collapse because they're scared. The market typically will rip in the opposite direction. And we saw that just a couple of weeks ago. We had a new entry price and the market started to move up. So we use our algos to identify these opportunities. We know when we can re-enter, when we need to start taking partial profits. When you kind of peel the layers back on the market, this particular chart here on the right tells us not only what people are thinking, but it's telling us what they're actually doing with their money. And that is the most powerful part, is when we can see what the average Joe is doing. They're doing something at an extreme inflection point. So as everybody's selling, the market is about to go even higher. So it's pretty amazing when you can flip things around and see what everybody's doing and know that when everybody's doing it, it's generally going to create a very strong move in the opposite direction.
That is fascinating. It appears that, you've mentioned dollar cost averaging, something that, sounds nice, but in practice is very difficult to do and maybe not the best strategy. You've also mentioned you have little faith in the buy and hold strategy. There's those who take the so-called value investing philosophy as a sacred sort of approach to things, because when you say you have little faith in the buy and hold strategy, it seems to fly in the face of the Ben Graham philosophy, Warren Buffett, who famously has said he tries to buy businesses that he never sells, Peter Lynch, on and on. This sort of value investing philosophy has been advocated for decades. So I'm wondering, do you think that philosophy and approach to the market is ever correct? And why is buy and hold not the best approach in your view?
Yeah, that's there's a lot of things in there, but the buy and hold works, but you never see somebody retire 20, 30, 40 years younger doing the buy and hold. It's just you don't get the big returns, right? And buy and hold works when you're starting a stage two, a brand new bull market. You buy a whole bunch of stuff and you hold it until that major long-term trend changes direction. But if you hold it past that turning point and things correct for multiple years, it doesn't make sense to do that. And unfortunately, the financial industry has everyone brainwashed that technical analysis is voodoo. They always say you're timing the markets, which I don't see it as timing the markets. I think I do things a lot differently. I think a lot of people try to pick bottoms. They try to time market tops. But what we do is we follow price. So we wait for the trend to reverse. We never get into the bottom and we hop on when everything's confirming. We just follow the trend and the money flows. And then when it turns around and starts to sell off, we don't get out anywhere near the top, but we get out as it's confirmed a downtrend. So we're not trying to time the markets. We're simply following the markets. And when you can identify when there's a strong trend or no trend, or you want to be out of the markets, it really makes things pretty straightforward. So overall, like I think this the whole buy and hold is it can work for some people, but there's such a better way to go about doing it, which you just have to have a little bit of activity, just enough to move your money around the market so that you're only holding assets that are going up. If nothing's going up, you can move to the sidelines and BIL, which is an ETF. You just collect daily interest. If you hold it through the first of every month, you get it paid out in a dividend, which is a lower tax bracket. And there's nothing better than sitting on the sidelines collecting 1/3% interest every month while the stock market is falling 5, 10, 15%. That, doesn't sound too exciting, but when you do it and you see everybody else losing their shirts, you're like, wow, this is great. We've got all of our capital. We're still making money every day and we're getting closer to a new entry point. So it's pretty exciting when you understand how the markets work. But I'm not a huge fan of the buy and hold. I think it's not very efficient.
So it sounds like your thoughts on the current market environment is now is a time to preserve capital as opposed to seeking alpha. You mentioned a BIL ETF is a way to collect interest. Would you also advocate short-term treasuries, money market accounts, and those other ways of just, making 5+% and sitting on the sidelines?
Yeah, and that's pretty much what Bill is. It's just a 1 to 3 month treasury note. They're just kind of expiring. They pay out their interest. So anything to get you out of whatever's falling, right? You're better to sit on the sidelines and earn a little bit of interest or no interest, depending on what kind of account you have, than it is to take losses and watch your account keep falling. And this is the thing. A lot of people say, well, if you go for it to be capital preservation mode, you're not going to make any money. And if you go for alpha to try and outperform the markets, you're opening yourself up to huge risk. This is where asset revesting really comes in, because we're protecting our capital, and because we're protecting it and always holding assets that are going up, we actually create alpha. So the buy and hold strategy has about a 38% max drawdown. So throughout your lifetime, if you're holding that strategy, you're going to lose almost 40% of your money, probably multiple times, and hopefully you don't panic out near a low. Whereas the asset revesting strategy, has got about a 6% drawdown. And we generate 2 to 3 times the return of the buy and hold strategy. So the alpha is huge. And most people always think you have to swing for the fences, or you got to be super conservative and not do very well. But asset revesting merges those two and says, no, if you actually follow these trends and identify strong trends and don't hold things going down, you naturally outperform because you're constantly holding something going up. So while the market's going sideways or down, our account just keeps going up. And that's what we keep seeing. Every couple of weeks, we're hitting new account highs. It's pretty darn exciting. Investors are blown away how consistent the strategy is, and how the markets can pull back and we still see our accounts go up. That's what blows a lot of people's minds. And we do it with very little risk.
Interesting. Well, in just a moment, I want to get to your service at the Technical Traders and how people can take part. But first, our goal on this show is to make people who are watching better investors in the commodity space, better investors overall. Obviously, everything you've discussed so far, I think, has helped greatly with that. But is there any additional idea, strategy, words of wisdom, something we haven't touched on so far that you can leave the audience with that could help them to that end?
It's tough. We've covered a lot. I think the key, I mean, if somebody is a passive investor with an advisor and they're doing the buy and hold, I think it's worth they should go to their advisor and say, if we do go into a bear market and the stock markets fall 30, 40, 50%, what kind of volatility is my money, at risk? And because they're in the buy and hold, unfortunately, their advisor is not going to want to tell them, but he's going to have to tell them, well, you could lose 30, 40, 50% of your money. And if people realize that the buy and hold, their life savings with an advisor who's supposed to be protecting their capital is literally just sitting there with huge risk at probably the most critical time. They're close to retirement or they're already retired and we're about to walk into a huge storm. They're probably going to be real shocked to realize that they're paying somebody to not even protect them from the downside. And I think, and if you're a really active trader, I think you need to realize, the less you trade is probably the better. It's trying to identify these big cycles. You can see here on my charts where these trades last 2, 3, 4 months at a time. And we just catch these nice waves that roll through the markets. I only trade ETFs, so they're very liquid. And it's all about growing our full account, not having a whole bunch of little trades and hoping some of them are huge grand slams. All we're looking for is a bunch of first, second hit, base hits on our trades over and over again. And it adds up in a real hurry when you've done that 4, 5, 6 times a year. And the ETFs moves nice and slow. They have very low volatility.
Well, talk to us about the service you provide at the Technical Traders. Obviously, asset revesting, something that requires some degree of knowledge in technical analysis. How do you assist people with doing that, and what is it you do at the Technical Traders? How can people find you?
Sure. Yeah. If they go to thetechnicaltraders.com, more or less, I run through the charts every week with everyone. So you get to understand what the markets are doing, what sectors are moving, what the intermarket analysis is telling us. The nice thing about this strategy is we can see trades coming days ahead. We know when how close we are to targets. We know when a trend is about to end. So there aren't any shocking kind of fast moves with this strategy. And what the strategy is I simply trade my capital and I share it with others. So you can take advantage of it in 2 ways. You can either just copy my trade alerts and execute the trades yourself, or you can have it auto traded in your brokerage account. And we have an auto trading system set up so you don't have to learn or watch or do anything. You literally just turn it on and the broker will automatically execute those trades for you. So I'm just a financial newsletter. I share what I do with my money and you can copy it or have it done for you. And I provide this asset revesting strategy where we only hold one asset class at a time, rather stocks, bonds, currency, or a cash interest bearing ETF. And we're only holding whichever one is moving up and whichever one has the most potential with the least amount of risk. So it is very, very simple portfolio when you only have one position more or less open at a time.
Great. Well, I'll put a link in the description to the technicaltraders.com for people who are interested in checking that out. Thank you so much for joining us, Chris, and sharing all your knowledge with the audience.
Hey, no problem, Jesse. It was a pleasure.
And thank you for joining us today. As a reminder, this episode is sponsored by ARC Silver Gold Osmium. Visit their website at arcsgo.com and contact the owner, Ian Everard, today at 307-264-9441 or by email at ian@arcsgo.com to get the best prices out there, and make sure to tell them Commodity Culture sent you. I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.